Today we're going to have a look at equity markets and specifically also at some sector rotations. We'll start with the graph of the S&P 500 on our fingraphs.com platform. This is an investor's view with the combination of a weekly graph for the perspective over the next few quarters, a daily graph for the perspective over the next few months, and an hourly graph for the perspective over the next few weeks. For now, all three are in very strong bull trends. What we could say is that the long-term graph is overbought at the moment. While our risk index reached the overbought zone, envelopes are touching each other, and our targets have been reached. So we may expect some consolidation over the next few months. Looking at the daily graph, we're in a strong uptrend, but it has reached its upside targets. Our envelopes are also starting to touch each other. The risk index probably has a bit more to go, but it's a matter of weeks. Now looking at the hourly, what we can see is that we're also in an uptrend, that there's still some upside potential towards 4,315. That the risk index, however, is quite overbought. So the trend here doesn't seem quite over yet and may extend once more into the overbought zone, but it's also a matter of a few days to a week here before it eventually makes an intermediate top. What has been interesting over the last few weeks is that the rotations within the market have moved back to growth stocks. And most of the move that we have seen since early June is really supported by a strong uptrend in the Nasdaq. So we've decided to compare here the Nasdaq to the SPY trackers, so the S&P 500, to try to understand where we stand in terms of these rotations. What we can see is that growth stocks and the Nasdaq topped out in a very overbought conditions. You can see the risk index here and our envelopes earlier this year. They have since been correcting down. It's probably too early to call a secular reversal here over many years, but at least we are in a strong intermediate correction for growth stocks versus the market. And we believe that this intermediate correction is probably not over yet and probably extends at some point into the summer. Looking at the daily graph, we're in a downtrend. We're in a downtrend that started in early February this year, saw a very strong sell-off during February and early March, has since been attempting to stabilize, but any bounces for now are counter-trend. And we do believe that this bounce here is another counter-trend rebound and that it may be soon coming to an end. So we do expect that by the end of the month, this rotation back into growth probably dies out, and we have another period of cyclical strength, probably into midsummer. We could also see it on the hourly chart here, where we've seen a very nice rally over the last few weeks, but that this rally is gradually getting overbought on our risk index, is getting into its targets on our price projections, and is also coming into stress with both our envelopes touching each other. So yes, the Nasdaq has helped the market quite nicely over the last few weeks and fueled the continuation of its linear uptrend, but this factor, or the support of this factor, could be coming to an end over the next few weeks. Now, it's interesting to look at the other side of the coin. And the other side of the coin is basically the financial sector or value stocks. And we've compared them here also versus the S&P 500. What we could see is that since last year, value stocks have really rebounded versus the market, and especially financials, which are now in a very strong uptrend. We don't believe this uptrend is over, although it has come to a first point of exaggeration on our envelopes. Yet the risk index does leave us quite a lot of further upside leeway, possibly into late this year, perhaps next year. Looking at the daily graph, we can see that we were in some exaggeration in the month of May, and we have since been correcting on the ratio. So value has been underperforming growth, as we have just seen with the Nasdaq outperforming the S&P. And indeed, we were quite in an exaggeration with both envelopes touching each other. We had reached our upside targets, and we were in an overbought condition. So we've since been correcting and correcting quite aggressively. And what we can see is that here also, and this is inversely to what we saw previously on the Nasdaq versus the S&P, we're getting towards a point where we can see another reversal. There's probably another week or so to go of downside of financials or financial underperformance versus the S&P. But the risk index is already getting quite oversold, the envelopes touching each other. So we do believe that financials could resume their uptrend. So here you're coming down and you could resume higher probably into the summer. Now this rotation over the last few months have kept markets from really correcting. Yet we do remember what happened in February, the last time growth really sold off. And if we do get this rotation back into value, and if it is quite strong, we wonder if it could not be the cause for some general market correction. So our scenario is that value probably comes back from late June, probably rallies into July, the Nasdaq underperforms and probably starts to fall on an absolute basis. This could actually bring the market lower, possibly into midsummer. Thank you very much and have a good week of trading.